Hi, this is Lara at Elliott Wave Stock Market with your daily analysis for Tuesday, the 4th of August. I'm recording today's video 6:15 p.m. Eastern Standard Time. I was expecting a little bit of upward movement. We got mostly sideways movement. Today's range was smaller than yesterday's, but we've got a small red candlestick. I'm expecting more upward movement for both wave counts, and regular technical analysis supports the idea at least for another 1 day, maybe up to 3 days. Once that's done, then I'll expect downward movement. This is the first wave count. It's reasonably bearish. It expects we've had a trend change back here at primary degree. To see an outline of the bigger picture and a discussion of what this primary degree fourth wave should look like, look at last week's end of week analysis video. I'll link back to it under today's video. I'll try and keep this video a little bit more short, more manageable and focused on recent movement. We need to see a 5 down develop if this is a downward move at primary degree. So far we have a deep expanded flat, and a third wave is underway at 1983. It would reach 4.236, the length of the first wave. That's the ratio I'm using for this target because this first wave is so short and the second wave is so deep. This is a third wave at minute degree, and it's normal for the S&P for its third waves at minute degree to show their structure very clearly at the daily chart level. The second wave correction is showing up, and when it arrives after the third wave down is done, the following fourth wave correction should also show up nice and clear, so that this third wave down has a very obvious 5-wave impulse look to it. The second wave correction is taking its time. It's unfolding most likely as a zigzag. I think the structure is incomplete. And a note about the candlestick missing here, it's still MIA. It may come back one day, but I'm linking back every day to the prior daily charts where it was shown. Let's have a look at how this third wave at minute degree is beginning, where it began up here. This point up here. The first wave count sees this downward move as a 5-wave impulse. I still think that has the best look. The second wave count has to see it as a zigzag. There's a problem with that. We have a 5 up here, a 3 down here, a 5 up, a 3 down. At the short term at least, those structures support the idea that we're going to get some more upward movement. This is a zigzag and they subdivide 5, 3, 5. The second wave count sees the upward wave subdividing 1, 2, 3 of an impulse. They have exactly the same subdivisions. So there's at this stage no divergence between the wave counts. Sub-minuet C has to be a 5-wave structure. It looks like it's going to be unfolding as a simple impulse. We have 1, a deep double zigzag for 2. I'll expect a wee increase in upward momentum tomorrow for a small third wave. The target for sub-minuet C remains the same at 2119. It would reach 0.618, the length of A. This green channel is drawn on both hourly charts in exactly the same way. In the short term, along the way up, the downward edge of the channel should provide or show reasonably where downward movement finds some support. For this wave count, once C up is complete, once it's moved at least slightly beyond the end of A to avoid a truncation, and whether or not the target is met, a downward move and a clear breach of that channel with clear downwards movement would confirm that this correction is over and the next move down should be underway. If this correction takes another couple of days, we may start to see the third wave of a third wave begin at the end of this week. The next movement down for this wave count expects a very strong downward movement, very, very strong to the downside as the middle of a third wave takes off. Minuet 2 may not move beyond the start of 1 above 2132.82. If price moves above that point, then this is the wave count I'd prefer to use. This is the second wave count. Instead of primary 3 being over back here, what if it's still continuing? What if the ending contracting diagonal at minor degree is incomplete? An ending diagonal requires all of the subwaves to subdivide as zigzags and the fourth wave to overlap first wave price territory. This diagonal is contracting because the third wave is shorter than the first, and a third wave may never be the shortest, so the fifth wave is limited to no longer than equality with 3. The maximum is where it were to reach equality at 2197.84. So although this wave count's more bullish, it doesn't expect price to move above this maximum point. If the fourth wave wasn't over here, and if it continues further, it too can't be longer than equality with the second wave because the diagonal is contracting. It has a maximum limit at 2022.07. That's why a new low below that price point would be provide so much confidence in the first wave count. Along the way down, if we see some support at this trend line, if it's not breached, this wave count will remain entirely viable. But if we get some real movement below this trend line, this wave count's going to start to look rather strange. It could only be at that stage that this fourth wave would be continuing further. Let's have a look at this at the hourly chart level, where A ends up here, this point up here. So we have to see this downward movement as a zigzag, and when we do that, the brevity of the B wave within it makes it look rather strange. I think this downward wave actually has a better look as a 5 than it does as a 3. And so for that reason, I do slightly favour the first wave count, at least with the way the second wave count's labelled here. 1, 2, 3 and ABC subdivided exactly the same way, but the target's different. At 2169, subminuet 3 would reach 1.618, the length of subminuet 1. The channel is the same, and along the way up, the downward edge should provide support to corrections against this short-term upward trend. If the target is met, then we would have some confirmation for this, we would have definite confirmation for this bullish wave count. It expects a third wave of a third wave is going to begin tomorrow, so it expects quite a strong increase in upward momentum. I'm removing the final target for the final C wave to end this final zigzag of the diagonal because it no longer expected a reasonable overshoot of the upper pink 1-3 trend line. You can see it better at the daily chart level. When we have subminuet waves 3 and 4 within the impulse of minuet C complete, then I'll recalculate a final target for this upward movement to end. It won't be above that maximum price point you see at the daily chart level. If subminuet 2 is not over, and if it continues any further, it can't move beyond the start of 1 below 2063.52. A little bit of regular technical analysis. I've now got data for the last 2 days volume, and it's actually showing a slight decline and levelling off. These 3 red candlesticks, this downward fall in price, is not supported by volume. That tells us that this is most likely a correction and not the start of a new trend, and that actually fits both Elliott wave counts. And so for the very short term, from this regular technical analysis perspective using volume, I'd be expecting a little bit of upward movement at least, maybe to find resistance at the lower edge of this band of resistance from the horizontal trend lines. The black ADX line for ADX is now flattening off and it's below 20, so it's still telling us there's no clear trend in the market at the moment, and so a range-bound trading system would be better used than a trend-following system, or stepping aside and waiting for a clear trend to develop before entering the market is the other approach. Range-bound markets really should be traded only by experienced professionals because they involve a much greater risk of loss. To avoid wiping out your account in this kind of market, essential money management rules like perhaps risking no more than 2% of your equity in any one trade so you avoid the risk of ruin is a really good idea if you insist on trading a range-bound market. I'm illustrating one really simple approach to a range-bound market here. It uses horizontal lines of resistance. I've created a small upper band and support, a small lower band. The idea is to use those resistance and support lines in conjunction with an oscillator. I'm choosing to use slow stochastics here because it works quite nicely for this market. The idea is really simple. When price reaches up into resistance and at the same time stochastics shows overbought, expect the end of an upward swing and the beginning of the next downward swing. Don't expect that downward swing to end until stochastics reaches oversold and price reaches support. Here, we might not reach into the horizontal support lines. I'm adding the 200-day simple moving average. It beautifully provided support here. It may do so again. If price comes to touch either the 200-day moving average or the lower support trend lines, and at the same time stochastics reaches oversold, only at that stage would an end to the downward swing be expected. Here's the reason. This is why it's so risky though. Along the way down there can be a lot of different swings. It can be very choppy and overlapping. The market can still move against you for a few days and still eventually reach your expected zone or target. And that's why trading these kinds of markets is so very, very risky. It's essential you use stops and very good money management to avoid wiping out your account. On balance, volume today is just starting to dip below its short green trend line. If once we have data for this red candlestick day, if on balance volume has moved comfortably below that trend line, that's another slight bearish indicator. The strongest piece of technical analysis on all of the charts is this double aqua blue trend line. This is drawn using the approach outlined by McGee in that classic technical analysis of stock trends. It's reasonably shallow, it's repeatedly tested, and it goes back to November 2011, so it's very long held. To use it in the manner McGee outlines, we should wait for a breach of it by a close of 3% or more of market value below that line. We have that for this day and this day, and so that's telling us the market has changed from bull to bear, and that's why my first wave count is my first wave count, ever so slightly favoured, but I really want price to tell us which wave count's correct. That's all for me today with your S&P analysis, and I hope that all of our members are having a most fabulous day.